One of the biggest lessons that I've learned is you don't know exactly what you don't know. There's tons of missed opportunity on the table. There's tax strategies to be had. There's prior year returns that you can go back and amend. There's asset protection strategies that need to be had. And the best part about this, guys, is that it doesn't require any additional work. Hey, what's going on, everyone? Welcome back to the Learn Like a CPA show. I'm your host, Ryan Bakey, and today I wanted to give you the 5 biggest takeaways that I learned from doing over 20 coaching calls in one single day. And I know that sounds outrageous and unbelievable. It's just something that I do from time to time. So I really like to survey you guys, survey my audience. And this is not my current clients or customers, but this is people who haven't even sent me a single dime yet. So these are people that are in my Facebook group. These are people on my email list. And if you ever want to be a part of that or ever want to be doing one of those coaching calls, you got to be on my email list. So make sure you either opt into one of our free tools or get on my Facebook group, Tax Strategies for Real Estate Investors. Give us your email and you'll automatically subscribe to the email list to be able to get access to these free coaching calls. And the reason why I do these is because I really want to understand the problems, the concerns, the frustrations that the average real estate investor is going through. And so after doing 20, 15 to 30-minute calls in one day on a Friday, this was Friday, it was 3 or 4 days ago. Here's the 5 biggest takeaways. The first one is that not enough investors are doing a cash on equity audit. Okay, a cash on equity audit is where you look at the equity that you have in your properties currently compared to the amount of cash flow that you're making on the property. Let me preface this by saying when I do this calculation, a lot of people ask, well, did I not make a good investment? And the answer is whether or not you make a good investment or not, I believe that's a cash on cash metric. But is the investment still a good investment for you? That's what the cash on equity audit is looking at, because I talked to an investor who had something like $400,000 of equity in a long-term rental. It was fully paid off. The property, unfortunately, was only cash flowing $5,000 a year. Okay, so $5,000 goes into $400,000 how many times? 80 times. So they would have to rent the property out for 80 years just to break even on what they could sell it for. Now, you might be asking, well, doesn't it depend on your goals? Absolutely, it does. If somebody is telling me that they want to quit their W-2 or they want to become financially free or they hate their job, whatever the case may be, they have to make sure that they're earning the highest amount of ROI on their equity that they have. And so that investor is better off selling their property, using it to go buy better deals that will cash flow quicker. I mean, hell, even if they just put that money in a 4% CD, it would earn $16,000 a year in income as opposed to the $5,000 that they were earning before, tripling their overall investment. And there's, quite frankly, no risk in a CD. Now, I say this because you really want to talk to somebody who's educated real estate investor to help you do these calculations, because it really is on a personal case-by-case basis. Doing the cash on equity audit doesn't just mean selling your properties and buying more properties. A lot of people would be surprised at how you can improve your overall financial situation by subtracting. And it's that age-old methodology of less is more, addition by subtraction. In fact, when the sculptor Michelangelo, when he saw that slab of marble, he didn't say, what can I add to it? He said, what can I subtract from it? What can I chisel away at that slab of marble? And that became the statue of David. So sometimes less is more. What can you get rid of in your portfolio that can really move the needle for you? That was the biggest eye opener that I had. The second point I want to talk about is not enough investors are liquid. And what I mean by that is we personally at my firm, as well as these are the people that I saw from the coaching calls, we take on about 25 to 30 new clients a month. And the first thing that we do with any new client is we make them fill out a net worth statement. And on the net worth statement, we want to know how much they have in 401ks, retirement accounts, cash, taxable brokerage accounts, HSAs, debt, all that type of stuff. We want to know how liquid you are. And what I found is that we help so many people that are $1 million, $3 million, $2 million net worth, But if I told them that they needed to take out $20,000 out of the bank by the end of next week, they couldn't do it. And that's because these people are not liquid. My best recommendation to you is you want to carry between 10 to 12% of your net worth in the form of cash or taxable brokerage account. Now, that doesn't mean that that money is just sitting on the sidelines not being invested. I said cash or a taxable brokerage account, because you need to ask yourself the question is, can you withstand your equity losing 30 to 40% in value? Can you withstand your properties not being rented out for what you plan on them, right? And if you run into any financial hardship and you don't have liquidity, well, guess what? You're going to need to be refinancing at unfavorable rates. You might need to be selling properties, et cetera. So you want to make sure that you're really liquid when you're going to be a real estate investor. And so that's why my recommendation is typically 10 to 12% of whatever your net worth is. You want to have that in liquid cash or a taxable brokerage account that you can grab by the end of this week. The third takeaway that I had from doing these calls is that a lot of investors are leaving money on the table because they're working with really bad accountants. So part of these coaching calls is I was getting the prior year tax returns from some of these people. And what I noticed is that there was just so much low-hanging fruit in the form of missed deductions. And I'm not talking like missed tax planning strategies. I'm literally talking about the prior accountant forgot to include property insurance, interest, taxes, cleaning costs, closing costs, missed depreciation. We got accountants that don't even know how to file tax returns for short-term rentals. And like the average investor, and we noticed this before I even did these coaching calls, but we noticed this in that the average investor is easily throwing away $10,000 a year by not working with a real estate focused CPA. And you are doing yourself a disservice by not having a CPA that's focused in real estate. It's not just enough for them to be a CPA that knows a little bit about real estate. They need to be focused in real estate. It's kind of like going to a general doctor to fix your heart or your foot or your hand, right? They're just a generalist. They're not a hand surgeon. And so that's the same thing if you just go to a general CPA. But I would say confidently, out of the 20 tax returns that we reviewed, 13 to 14 of them had over 5 figures in missed opportunities and deductions. Just amending the return for these people would get back those missed savings. So make sure you're not leaving money on the table. The fourth biggest takeaway is that a lot of investors have no proper asset protection or strategy. I mean, we still see people that they open up every single LLC under the sun. They get told because they read on Bigger Pockets or a Facebook group that they need an LLC for each property. And then you have that dance where the property is in their personal name, the loans in the personal name, but the title's in the LLC or something like that. No proper asset protection structure, and it's going to cost you a lot of money if something goes wrong. Because if you don't have a proper asset protection structure and a plan, well, all those assets are in your personal name as opposed to your business and your LLCs. So you're 100% liable for all of that. And a lot of investors do not have a proper plan. Now, I'm not saying you need to go to an Anderson Advisors. I mean, please definitely don't go to them. I'm not saying you need to go set up this huge, aggressive asset protection plan, but have a little bit of something. I mean, if you got kids, if you got a legacy to live behind, you can't stand losing part of your net worth because of a lawsuit or a simple slip and fall on your property. Be protected. The average real estate investor is not protected from damages or danger in one of their properties. And guess what? If you don't have your properties in LLCs, then isn't everything at risk? Can't they come after your whole portfolio? So don't make that mistake that a lot of investors do. Invest good money in asset protection. I think also too, a lot of people overestimate the cost of what this is going to be. I mean, you can file LLCs in most states for a couple $100 each year. And if you do it the right way, you're not going to have to file additional tax returns for those LLCs, especially if you listen to the stuff that I talk about. Okay, the fifth and final thing. Oftentimes, investors believe that they have X problem, but it's really a Y and Z problem. For example, somebody might come in with what they think is a tax question, but really it's a legal and a lending question. Or maybe it is a lending question, but it's more of a tax and legal question. And so you don't know what you don't know. And that's why it is very important to have somebody that can allow you to see where your blind spots are at and to kind of take that tunnel vision goggles off, if you will. That's why, shameless plug, that's why my company, Tax Strategy 365, helps real estate investors do this, because we help people when it comes to tax strategy. We help them when it comes to lending. Are you bankable or not? We can help people set up their entity structure from a tax perspective. We can help people understand their financial picture a lot better than what they currently are. And this is one of the biggest lessons that I've learned is you don't know exactly what you don't know. And so by asking more and more questions, you're going to have a better overall picture of your financial health and your wherewithal. So these are really just the top 5 takeaways that I had from doing these coaching calls. And, like I said, it just pains me. There's tons of missed opportunity on the table. There's tax strategies to be had. There's prior year returns that you can go back and amend. There's asset protection strategies that need to be had. And the best part about this, guys, is that it doesn't require any additional work. So a lot of people in real estate ask, like, hey, how do you make your next $10,000 in real estate? How do I make my next $50,000 in real estate? Go figure out how to save $10,000 in taxes, lending costs, filing fees, because saving money is also making money, is it not? In fact, there's a study that says that if you lose $10 on the ground, you have to make 5 times that amount. You have to make $50 in order to have that same emotional, psychological, whatever it is, if you will, for them to offset each other. So for example, the pain that I get from losing $10 out of my wallet versus finding $50 on the ground, those are the exact equal things, even though I have to find 5 times the amount. But a lot of the real estate investors are leaving 5 figures on the table by not having good tax planning and not having a good team behind them. And so that's just my call to action for you guys. Make sure you have a good CPA. Whether it's me, I really don't care or not. I've never taken $1 for a podcast ad. That's why you'll never see me be sponsored by anybody. I don't want anybody to ever censor what I'm able to say on this thing here. But if I had any call to action for you guys, make sure you invest in yourself, your health, and your well-being. And that's going to wrap up for today's episode. Again, if you want to make sure that you're on the email list so you get access in case next time I do these free coaching calls, make sure you join the Facebook group, Tax Strategies for Real Estate Investors. Got over 10,000 real estate investors in there engaging daily. You can also go to the website, taxstrategy365.com. Grab a free template. You'll give us your email. You'll be on the list. And so that way you will never miss out on another opportunity for a free coaching call by yours truly. And thanks for tuning in to today's episode. And we'll see you guys next week.